Well, good afternoon. Happy Friday, June 18th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. So, first of all, we'd be remiss if we didn't acknowledge that the president signed into law yesterday the Juneteenth National Independence Day, of course, commemorating the end of slavery in the United States, now a federal holiday. The holiday is actually June 19th, which is tomorrow, but many businesses, including Highland Mortgage, celebrating Juneteenth today. So very, very proud as an American to celebrate this holiday. Let's get to what happened to interest rates over the past 5 business days. So really this year has been a tale of 2 years. When February, March, April, a lot of volatility, a very tumultuous time where we saw big sell-offs in mortgage-backed securities, driving interest rates higher from those historic lows in 2020. But really since then, over the past 60 days or so, we've seen a relatively calm market. That was set to change this week with the Fed's regularly scheduled meeting on Tuesday and Wednesday. That's part of the regularly scheduled time that they meet every year. They meet 8 times per year as part of their regularly scheduled for a policy statement and also announcement of any changes to the federal funds rate. Well, no one expected the Fed to alter the federal funds rate, at least not at this point, Tuesday and Wednesday. With a policy statement coming out at 2 p.m. Eastern time, the Fed really kind of kept in check what we all anticipated is they're going to keep a close watch on inflation. They think inflation is ephemeral, that it's a bit temporary. We're seeing a lot of inflation due to supply chain issues, pent-up demand from the pandemic, and of course, comparing year-over-year measures with where we were a year ago, which certainly was not an inflationary environment. So the Fed sort of echoing that they're not too terribly concerned about inflation. What happened that really drove the markets is the Fed's press conference after the policy statement. That's where things kind of came unwound for mortgage interest rates, and the Fed maybe didn't do the world's best job in terms of handling those questions and reassuring that the press and really the America at large of what their policy was. They sort of used the language like they're beginning to talking about tapering their mortgage-backed security purchase program. Let's talk about that for a second. So the Fed is in charge of the Fed funds rate. We know that, but the Fed has also been a market participant, buying up $40 billion per month in mortgage-backed securities, creating this artificial demand for mortgage-backed securities, which in turn drives interest rates lower. Well, anytime the Fed starts to taper off of those purchases, or even indicates they might taper off of those purchases, we're going to see interest rates start to bubble up. And the Fed alluded in the press conference that maybe they're not ready to do that yet, but they're thinking about it, and they're talking about it. And anytime you get into those kind of gray, uncertain waters, boy, a big sell-off in mortgage-backed securities. Here go interest rates up. The market does not like indecision. The market does not like clarity. And that's what happened on Wednesday afternoon. Let me show you what I'm talking about here with mortgage-backed securities. We'll get over to our candlestick chart. Here's Wednesday. And when the 2 p.m. policy statement came out, no movement to the Fed funds rate, no movement in terms of inflation. We got down to, I would say, right about here where the center of that circle is. And then the press conference happened with Jerome Powell, and we sold off an additional amount here, a really sizable amount that came after the policy statement, and that's all centered around talking about tapering and thinking about tapering. Now, Thursday and Friday, we've recovered a lot of this ground, which is really good news and goes to show you how volatile the market can be just based upon the comments issued at a press conference. All that being said, we did lose a little bit of ground this week with mortgage interest rates, something we got to keep our eye on. The next big date range is going to be in August when the Fed meets again. There's probably going to be some reference again to tapering, talking about maybe a time frame in early 2022, mid 2022, when the Fed may begin to taper its mortgage-backed security purchase program. That's far more important than what's happening with the federal funds rate. First of all, the federal funds rate doesn't set mortgage interest rates. It's an overnight lending rate. It's not a long-term interest vehicle or long-term instrument. Second of all, we're really still not talking about raising the federal funds rate until 2023, a long ways from now. So of utmost importance is the Fed's stance on purchasing mortgage-backed securities. Are they going to begin to taper? When are they going to begin to taper? How much are they going to taper? That's really the market mover as of this point. If I can be of any assistance to you this weekend over our holiday weekend, please don't hesitate to reach out, mark.milam@highlandmtg.com. That's 404-395-1102. Now licensed in Tennessee, Florida, and South Carolina, as well as, of course, Georgia. You have a good weekend.